My name is Kurt DeBerg, and I'm an accounting professor at California State University, Chico. I've been an accounting professor here for 28 years, and every single semester I've taught principles of financial accounting. And I've always paid tribute to the father of double entry bookkeeping. His name is Luca Pacioli, and this is his book called the Summa that he wrote in 1494. And in the Summa, he brilliantly documented the Venetian bookkeeping system, whereby all changes on the left of an accounting system would always equal the changes on the right. He called this system a double entry accounting system because two accounts were affected with each transaction. And in order to balance, he created a system whereby a T account was created with the left-hand side of the T account called the debit side, and the right-hand side was called the credit. And in this system, there were no negative numbers. So in this first of two videos, I've entitled this, "What if Luca Pacioli had electronic spreadsheets?" I've taken the case of Doe's printing business, and Doe's printing business has 5 or 6 asset accounts beginning with 1. It has 2 liability accounts beginning with 2, and it has 2 equity accounts beginning with 3. There are temporary equity accounts called revenues, expenses, and dividends, which could go directly into retained earnings, but we historically have put them in our separate accounts and closed them into retained earnings at the end of the period. Now, if you recall from Pacioli's treatise, let's go to Pacioli's 10 steps. He used 10 steps in the accounting cycle, and I'm going to drag those right over here, and I'll enlarge this. And if you recall, painfully, we had to memorize when we first learned accounting that you would identify a transaction, analyze it, make journal entries, and post the journal entries to the ledger. And at the end of an accounting period, the ledger balances would be prepared such that all accounts with debit balances would be subtracted from all accounts with credit balances, which should be 0. We would then make our adjusting journal entries under accrual accounting and then prepare an adjusted trial balance. From that, we would prepare our financial statements. I call them, of course, the balance sheet, the income statement, and statement of cash flows. There's a fourth statement called statement of changes of stockholders' equity, but we can embed that in the balance sheet in our system here. And then, of course, we would make closing entries, and then finally, we would make sure we again balanced. There are 3 steps in the basic accounting cycle that require us to balance. But if Luca had electronic spreadsheets, he would balance with every transaction. He'd force it. He would engineer a self-balancing system such that the left minus the right equals 0. So let us see how that would work in Luca's system. If John Doe contributed $50,000 cash from his personal funds to start Doe's printing service business on January 1 of this year, how would you record it in the journal? You would record it by debiting cash, you recall, and crediting common stock. Let's make that big so you can all see that. You would debit cash and credit common stock. Now, the second transaction, he would buy equipment for $30,000, crediting cash, and debiting printing equipment. Now, in our transactions, we see he bought equipment on January 1 of 19, and he uses straight line depreciation with a salvage value of $5,000. So our traditional journal entries, there's your first one, and here's your second one. And of course, these entries would be posted to the general ledger. And our general ledger, of course, is 1 page for every account. And here we'll just make T accounts. And so transaction 1, we would debit cash for $50,000 and credit common stock. But check out this. Our sum of all left minus the sum of all right has to equal 0. And Luca would have said, if we had entered this as 5,000, we would enter this and we would be off 45 grand. We would not go on until we made sure each entry balanced. And that's the beauty of how, if Luca needed to use debits and credits, he would make sure the left minus the right would equal 0, or his debit credit check. He would also make sure to build a balance sheet, an income statement, and a statement of cash flows based on each transaction. Here he debits cash, credits common stock. The balance sheet goes up cash 50 and equity up 50. Debits or left equals right. There's no effect on the income statement. And of course, the statement of cash flows, cash goes up 50 grand from financing activities. Cash up 50, and that's your ending balance right there. So if you've had beginning accounting, you would see that you would debit cash, credit common stock. The next transaction, you would credit cash and debit equipment. And we would see the effect on the financials. Transaction 3, spends 4,000, cash credit, debit prepaid rent. Notice we still balance. If he had entered 400 here rather than 4,000, we would be off $3,600. We don't want to do that. Let's fix it as we go on a real-time basis. And notice if we had entered 400 here, that our balance in the balance sheet would no longer balance. So if we put 4,000 here, everything is in balance. Cool beans. Transaction 4, we spend 4 grand to buy what? What did we buy for 4 grand? We credited cash and we debited prepaid rent. Transaction 5, we debited cash, credited revenue. Transaction 6, we debited accounts receivable, credited revenue. Notice that revenues are 18,000 now. So in our income statement, revenues are 18 grand, and that articulates with our net income in our equity section. Net income up by the same amount as net income in the balance sheet. That's pretty awesome. Next transaction, we spend 1 grand to pay off our accounts payable. We then spend 3,000 to pay off our current period salary. Next, we increase cash when we collected on accounts receivable. Transaction 10, we increase cash when we sold merchandise for cash. Again, if we had accidentally entered 1,500 here, we would be off, way off. Let's fix that as we go. That's really 15 grand. Transaction 11, we adjust our supplies. We used up 80% of them. Credit supplies, debit supplies expense. Transaction 12, we adjust our rent for 1 month's rent. Credit prepaid rent, debit rent expense. That could be 1 month or 1 year. Then we depreciate our equipment. How much? We depreciated $500, and we could show students how we do that using our straight line method. But right now, credit the asset through the contra asset account, debit the expense. Transaction 14, we accrue salary for salary earned this period but not yet paid. And then last, we pay a dividend. Cash goes down, dividends reduces our equity. And notice in our income statement that 2,000 there goes right there. Now, we've done nothing. We've not had to prepare any financials. Our income statement shows 23.7, which articulates to the balance sheet. Our statement of cash flows shows 42 grand, which articulates to the balance sheet. We've had to prepare nothing. We've seen how each transaction hits the financials. And lastly, we update our financial ratios as we go. And now the finance professors don't have all the fun. The accounting teachers can show what current assets to current liabilities is, what return on sales, return on equity, return on assets, or even debt to equity. Now, Luca would stop there. He wouldn't need to go any further, but we teach our students and we say, add up all the left, subtract all the right, make sure your balance is 42,000, but we already know that. We would also have them do this unbelievable 12-column worksheet, where 3 of the steps are to balance. But we know that with our transactions, with every single transaction, we balance. If we made this one 800, we would be able to find it. No, that's wrong. We need to balance. This ends our lesson on what if Luca Pacioli had electronic spreadsheets, subtext, and he still insisted on using debits and credits, which in the next video I'm going to show you. This system is quite cumbersome and is not really needed to help anybody understand anything about accounting. Thank you.